Move on to tax tips. And Chris, something I wanted you to talk about too, because I've had a lot of questions lately, is the step up and how that works. Chris Haro is a CPA that a lot of people on this call actually have Chris do their taxes, and he watches over me all year long, actually. So, Chris, take it away.
So I am a CPA. I have been a licensed CPA since 2001. My youngest son says CPA stands for Certified Public A blank. And it has the word whole in it, if you get my meaning. But he is the youngest for a reason, and he's the most, he hasn't grown up yet either. So we'll leave it with that. I wanted to, since this is a real estate club per se, we're all real estate, I wanted to talk about some difficult issues in the tax regarding mortgages first, and then some rentals, and then some other tax tips, but I want to talk about mortgages. As an individual, under the current tax code, you can deduct mortgage interest on $750,000 of acquisition indebtedness. This includes a first and a second home. So let me give you an example. If I have a home in Huntington Beach for $500,000, I have a home in Big Bear or Lake Arrowhead for $500,000, I'm only able to deduct the mortgage interest on the first $750,000. This is part of the Trump code. It will fall off in 2025. So in 2026, the code will go back to the old $1 million limit. The other thing I want to stress with this is there is a grandfather clause. If the acquisition debt is before 12/15/17, you are able to stay at $1 million for indebtedness to write off. In other words, in my example, it would be 500 and 500, you would be able to write off 100% of that mortgage interest. The other thing that a lot of people don't realize changed is home equities are not deductible anymore, but it really depends on what you use the funds for. If I take out $100,000 home equity line of credit and I use it to purchase or to build a pool and add on to my house, that's considered acquisition debt subject to the 750 limit. If I take $100,000 out and go on safari, buy a new car for me and the family, that would not be deductible. If I take out that $100,000 and use it to buy a business like a franchise, then it wouldn't be deductible on your Schedule A as an individual, but it would be deductible in your business as a business expense because you're financing your business. So again, these changed with our housing prices, especially in Huntington Beach. There's a lot of people who are not able to deduct all of their mortgage interest. Just a practice point, when I look at it, the lenders are now required to tell me how much the outstanding mortgage is. And I basically take a percentage of what I could deduct. So it's nothing you guys need to do, but at the same time, I want you to be aware of it. A tax tip. You ready? Buy rental properties. These are get rich over time. It's not get rich quick. Why is it get rich over time? Let me give you me as an example. I bought a rental property that I held on to 10 years. It was out of state. So the property itself did not appreciate that much, like Huntington Beach or Newport Beach. However, my tenant paid off my debt over those 10 years. So he built equity for me. That's how I was able to gain wealth. So when I sold it, I tripled or quadrupled my money because the tenant paid off the debt for me. In addition, as it's a rental property, I was able to shelter the income or the gross income with my expenses of depreciation, interest, repairs, and what have you. So over those 10 years, I paid very little taxes on it. It actually sheltered some of my other income. The other great thing about rental properties is it builds wealth for me and my heirs, so I could pass this down to my kids. Prop 19 changed a lot of this, but we're not going to get into that here because Prop 19, we're still waiting on precedents and interpretation by the courts. So that's another ball of wax. The other thing I want to talk about rental properties is I just talked about on your Schedule A or your primary residence, the interest being limited to $750,000 of indebtedness. On a rental property, you get to deduct 100% of the interest. So if you buy a house on the beach, what, $2 million, Cheryl, in Sunset? You put 20% down, so that's $1.6 million, and you're renting that. All of that mortgage interest is deductible because it's a business. It's not your primary or secondary home. So you're able to deduct it all. One of the other things I like to talk about for those of you who have rental properties, majority on your insurance on your rental property, majority of the people know to have fire and liability because it's required by the lender. It usually comes with loss of rents. However, I recommend adding 2 additional riders to your policy: vandalism and malicious intent. Because if you have to evict a tenant, they're not going to be very happy. A lot of the times they don't leave quietly, they damage your property. That damage is not covered by your insurance, it's covered by your pocketbook. So by adding these riders on, which are deductible, if that were to happen to you, you're not out all that cash and you'll be able to file a claim. And not a lot of people use those riders, but to me, it's important because on $1 million house, what is my mortgage payment? What's mortgage payment on? So 6 times 10. So it's a $6,000 monthly mortgage payment. So if my house isn't rented, I have to pay the mortgage of $6,000, plus I have to come up with money for these repairs. It's nice to go to the insurance to get these funded. The other thing that is great on real estate is we could use our equity in our primary residence or a different rental property, take the equity out and use that to buy more. And that's a great way to start building your wealth, again, over time. The next
we have a question, and I want to back up on, because we did a whole thing on Prop 19 with Attorney Kevin Snyder. They still don't have all the answers. I called the county yesterday, and the county couldn't answer my questions. So that's pretty sad to put a new proposition in place and not have all the answers yet. But so I just tell people, you know what, fill out the form and see what happens. That's all we can do right now. But Natalie wanted to know, if purchasing rental property out of state, do you recommend certain markets and areas? And I will say, we do have offices all over the world. If you tell us your budget, we'll tell you where you should go. But Chris, where was your property?
I found properties in Boise, Idaho, Jacksonville, North Carolina. I always say this wrong, Fayetteville, North Carolina. You could correct me on the enunciation.
So Boise has blown up like crazy, but
in Charlotte,
China, you can still get good deals.
So any of those locations I still like. And the reason being is there's a lot of industry that's not going anywhere. Charlotte is banking. Jacksonville, North Carolina has a military base. It's called Camp Lejeune. So you always have stable renters. Even if they're shipped out, my house would be rented. They would get shipped out, and within the end of the month, I had it rented again, and I never lost any rent on that place. That was one of my best ones. And San Antonio.
Where a military bases or a college town is usually.
College town, they're kids, so they're not. You just remember you're gonna have more repairs. Yeah, but you're just.
Well, that's true. More repairs. Good point. Good point. Yeah.
And I like San Antonio. They have a big medical as well as military. So that's a good place. And I'll give you this example, even though it's kind of outdated. I guess I could update it. I could buy one house here for $1 million, or I could buy 5 houses for $200,000 out of state. If the one house here is unrented, my out of pocket to pay that mortgage is going to be $6,000 ish per month. But if I have 5 houses out of state, chances of all 5 being unrented at the same time is low. 1, maybe 2, but then these 3 would be cash flow positive, and they should still be able to finance this one. Going out of state, the only drawback is you don't get the price appreciation we get here. You build equity by paying down your mortgage. And again, somebody else is doing that for you. I like out of state rental properties. Everybody is, well, why do you out of state? Well, it's cheaper. Well, how do you manage it? I hire a property manager. What if they do a bad job? I do another one. Trust me, you learn. It's your money. The other thing about rental properties, it is a part-time job. You have to do the accounting and the work and making sure that the money's coming in and keep an eye on your employees or your property manager. But it's not hard. You're not spending hours doing that. It's maybe an hour a month. If that, once it's on autopilot, it's even less than that. Then where's my time? The next thing I want to talk about is property taxes. So in the news, we've been hearing about the salt tax. Salt tax. What is this salt tax? Salt tax stands for state and local taxes. What is included in here is your DMV fees, your property taxes, as well as any state income tax paid. The more money you make, the more state income taxes you pay, and you might not be able to deduct it. And let me give you and this limit is capped at $10,000 currently until 2025. So if my state income taxes are $15,000 and my property taxes are $7,000, it doesn't matter. I only get to deduct $10,000 of it, $10,000 of those amounts. However, the property taxes, I could deduct the full amount on my state. I might not deduct the full amount on federal, but I get to deduct the full amount on state. The last thing I really want to talk about this is, because this has been such a hot topic. A lot of people who are subject to the SALT limitation of the $10,000, they're also subject to another tax that people don't talk about or you hear in the news called AMT, Alternative Minimum Tax. So if my Schedule A says I get to deduct $100,000, the AMT will kick in and say, no, based on your income, you only get to deduct $50,000. Your state income tax you paid is a preferential item, which usually makes AMT hit. So not a lot of people got to take all of their state taxes anyways. It's just one of those things that the media catches on and runs with it. A couple more things I want to go over. I'm looking for questions. I don't see hands. Home office. Is a business home office deductible? Now, I just said the key word is a business home office. So if I'm running my own business and I have a home office, yes, it is deductible. If I'm working from home, like a lot of people are, it's usually not deductible for federal, but maybe for state. So do you understand that difference? If my employees are working from home up north, they are employees. One of the Trump tax codes did away with the home office deduction for employees. So the employee cannot deduct his home office. However, a small business owner is able to deduct their home office. It goes on a different form. The state of California does not conform to this. So even though my employee cannot deduct his home office on federal, he can deduct it on the state tax return. So as with everything, it's always maybe, and that's why the preparers always have to ask you so many questions, because the law isn't simple black and white. Thanks. Where'd she leave? Natalie. Thanks, Natalie, for making complicated laws. It's never simple black and white. It's always, it could be here, it could be there. I spend at least 40 hours a year updating myself with the new tax codes because I have to, because they keep changing it. Congress says they want to simplify the tax code, but they keep making it more difficult. 2 years ago, 3 years ago, the 1040 was 2 pages. It's still 2 pages, but there's an additional 5 schedules that follow it now. So I thank them for making it more simplified. I want to talk about RMDs. For those of you who don't know, and Paula's already saying, oh, okay, thanks, Chris, for talking about this. RMDs stand for Required Minimum Distribution. The IRS and Congress had said, we want you to save money in your retirement. I'm glad that Huntington Beach is fully funded. That's a big thing. We want you to save money on your taxes, but it's a tax deferral. We don't want it to keep growing. We want you to defer these taxes, but yet we still need to get this money into our coffers. So at 72 years old, you have to start taking money out of your tax deferrals or qualified plans. A qualified plan would be a 401k and an IRA. That's going to cover majority of us. So at 72, the April in the year you turn 72, you have to take an RMD. Not taking the RMD is a very bad thing, and they could take half of the RMD, I think, away in penalties. So usually your trustee or custodian who's holding the funds knows when you're going to turn 72, and they should be reaching out to you. One tidbit I want to talk about on this RMD, you could actually have your trustee donate the money to a charity instead of you taking the funds. So let me give you an example. If my RMD says I need to take out $10,000 this year, I don't need the money, but I have to take it out by law. Well, if I take out that $10,000, it may put me into a different tax bracket. It may make some certain credits and deductions go away. So I don't want that money, but I have to take it out by law. I could have my trustee give this money to the women's club. And what's your women's club, Cheryl?
Sunset Beach Women's Club. They'd be happy to have that 10,000. If anybody's in that position, please let me know.
So I could have my trustee send a check to the Sunset Women's Club. It counts as my RMD, but I'm not paying any taxes on it. And then you're going to say, well, Chris, but you would get a tax deduction on it anyways if you donated the whole 10,000. Correct, but that $10,000 is not in any other calculations that might raise my tax rate, that might have me change my deductions, it might do other stuff. It just bypasses my whole return. And you get you're helping out a charity. In closing, I have to give you some tax tips. Now, the first tax tip passed, but I'm going to tell it to you anyways. For your January mortgage, pay it on December 31st. Pay it in December prior to January. And the reason is we are all cash basis taxpayers. So when the mortgage company gets that payment in December, I paid that interest in December and it gets to go on my tax return for 2021. It's only a day sooner, but I get the deduction in 2021. Paul is going to attest to this. Max out your retirement accounts. This is the best place I could save you money. If you're in the 25% tax bracket and you're saving you're saving a quarter on your taxes. So your retirement account gets $1, but it really only cost you 75 cents because that quarter would have went to Uncle Sam. Now that quarter goes into your pocket. So you're already getting a 25% rate of return on your money, or just pay Uncle Sam. Same thing with the mortgage property. If you own a business, pay your January expenses in December. So I have a business coach. I have my rent for my location. There's a lot of things that I had the cash. I prepaid it in December. I know I was going to spend it, but by writing the expense in December, I get the deduction in 2021, not 2022. I always say this, and I have to talk about this. I cringe when somebody tells me they bought something for a tax deduction. Now, if you needed that item, then great. But too many people will go out and buy something just for the tax deduction, and it's opposite of your retirement account. They are paying 75 cents to save a quarter on their taxes. They didn't need that widget. Just don't buy it. Or this is the other thing I tell people. Give me $1, come back a year from now, I'll give you a quarter back. Now I will keep a quarter and give you the 75 cents back. How does it go? Come back, give me $1 this year, I will give you 75 cents a year from now, and I keep a quarter, because you're really paying the 75 cents to save a quarter. I still said it backwards. But don't buy something for the tax deduction unless you need it. Again, if I know I'm gonna buy computers in January, I'm gonna purchase them in December. I'm gonna try to move them. The last tax tip I wanna say is, I have a lot of agents on here, is if you own your own business and you're a sole proprietor, is it time to incorporate? That will save you a lot of money. On $100,000 net income account, it could save you roughly $7,500 by incorporating each year. So is it time to incorporate? No offense,
And I
Natalie.
have to attest to that because my last CPA never told me to do that. And you immediately had me do that years ago. And that has saved me a ton of money over the years. So thank you, Chris, for that recommendation. And it was so easy to do. He helped me do it too. So
Cheryl wanted me to talk about step up in basis, and this will be the last thing I speak about.
and the
So
reason being, we've had a lot of people pass away, a lot of spouses pass away. In fact, Paul Armstrong, who was a regular viewer, he was way before we did Zoom. He was a Kathy Mays with us. He passed away late last year. And I mean, I just miss seeing his face because he was always on here, always with us. But he unexpectedly passed away last year. But we've had a lot of people lose their spouses, some to COVID, some just, so the step up, most people don't have a clue about it. And it's the only good thing about losing a spouse.
So I'll use my parents as an example. My parents bought a duplex in Pomona back in the early 80s for $74,000. It was fully depreciated, which means they've been writing it off for over 27 and a half years. My father passed in 2013. They held the property as community property, and it was in their trust as community property. So when he passed, my mom's purchase price was no more than 70,000 less depreciation. Her purchase price is stepped up to the value at the time of his passing, which was 300,000, or 6 months later, we used the 300,000. So what does that mean? Basis is a fancy word for your purchase price, but I can't use purchase price because in this example, their purchase price was 74,000. But for taxes, when she sold it, her purchase price is 300,000 because we got to step up in basis when he passed. Something not to do for those of you who have kids, do not put your children on title. If you put your kids on title, you're gifting them half of their purchase price. So in my parents' example, I'm going to use 70,000. If they put me on their title, half of that 70,000 or 35,000 would be stepped up to 300,000, or half of that, which is 150. Mine would stay at the 35,000. So that property sold would have income taxes. If you put it in the trust and have it go through the normal legal stuff without you being on title, the whole property is stepped up and you get to sell it tax-free. And really you get to sell it at a loss because you have to pay our commissions for our favorite real estate agents like Mercedes and Cheryl. We got to make them happy. But it's a tax deduction, so I get to deduct my commissions on my tax return when I sell that. But step up in basis, it's a big deal. Biden's trying to take it away from us and to build back better, but that bill's, I think, is officially dead. But I also just read today that they're going to break it up into 3 or 4 smaller bills. So hopefully they don't take away our step up in basis, because that's what helps our economy grow. An example, because of Prop 19, this changed, but I'll let you use your imagination. If my parents had a house in Sunset Beach and they passed, I get a step up in basis to, we'll say it's 1.5 million. I make it a rental property. My property taxes stay low due to Prop 13. So my property tax is going to be minimal. And I get to depreciate it. So all of that income would be most likely tax-free or tax deferred because I'm building down my basis. Of course, I'd rather have my parents, but it's nice of them to leave me that house. Prop 19 changed it to where if you make it a rental, it's going to be reassessed. You have to live in it. But prior to Prop 19, it's a great way to turn an inheritance into a nice income stream. I'm gonna see
But
if there's any
seriously,
questions.
if you're making money on something, you should be taxed. I mean, I'm not totally against Prop 19. So if it's going to be their primary residence, okay, great, they get to keep that tax base. But if they're going to use it as a rental for income, I think if you're making money, you should pay the tax. But one thing it did do that was really great was before you had to buy a property that was the same or less in value. Now you can, because we had the problem of so many people wanting a single level home, and with the baby boomers all up there in age, single level homes have skyrocketed in price. So they couldn't take their value or their base value with them because these single level homes cost more than their 2-story homes.
So just to clarify, I'm going to cut you off here. I want to make sure everybody understands. So what I'm talking about when I say cost basis, it's their purchase price for selling the asset at a gain or loss. Cheryl's talking about the basis in your property taxes, which determines how much you pay in property taxes year over year, subject to a 2% increase. So when the baby boomers, when a mom has a 2-level house, they want to downsize, but they want to stay in the same neighborhood because that's where all of their friends are, they usually can't find a house cheaper than the one that they want to buy or that they're selling. Prop 19 lets them go both ways, meaning a lower price house or a higher price house. There's rules and regulations, of course, and how they reassess it, but they're not locked into downsizing to a smaller house. The other thing about Prop 19 that I like is they got rid of the county transfer restrictions. It's for the statewide in California. Whereas before it could be Orange to LA, but you might not have been able to go up to Sonoma. There were some counties who weren't reciprocal, but now it's throughout the whole state. So if your parents pass, houses and trust that goes to you with Prop 13. If you are living in the house as your primary residence, and if it's over $1 million, up to $1 million, over $1 million, some of it is going to be reassessed. But you have to live in it as your primary residence. I talked a lot. I probably talked fast. Hopefully I talked clear and cohesive that you can understand me.
Can you
go back?
Questions?
Can you go back over what Cheryl said? She wishes her previous accountant had told her that saved her a ton of money. Can you hit that point again real quick?
So as an independent contractor, sole proprietor, you're subject to self-employment wages, which is, just to make the math easy, 15%. So if you make $100,000, you owe $15,000 in self-employment tax, plus you're going to owe income tax on the $100,000. So you're paying 2 taxes, self-employment and income. Being a corporation, we could write your wages down to $50,000. So you'd pay $7,500 for self-employment tax. Then the other $50,000, we would have it flow through to your personal taxes and you wouldn't have to pay that $7,500 on it. And then as long as there's no IRS agents, right now, having a corporation, your audit risk is lower because you're a bona fide company. IRS is they're supposed to be changing that, but we'll see. So you just save more in taxes. However, if you're not a good saver, I know you are, but if you're not a good saver, then I'm going to tell you not to do it because at least you're contributing to your Social Security and Medicare. But you're already contributing to your retirement account, so I know you're a good saver, so you're not as concerned about your Social Security.
I recommend, Chris, put your phone number in the chat box, but he is phenomenal to see. He's got an office in Huntington Beach now as well. And you can make an appointment to go in and sit down with him, and great advice. And you might want to get him now before he gets really busy, because once he gets into tax time, you will not be able to get a hold of him. I can't blame him. So now, or wait till after April. So.
Yep.
Thank you, Chris. That was great. We so appreciate it. It's always nice. We always have, it's all education. No one's trying to say anything. We have attorneys, CPAs, financial planners, it's, find out what's going on with the city and then get an education afterwards.
Yeah, I wasn't here to sell you. I didn't even put my information out there. I just enjoy
Oh, we want
talking
you
and
to.
educating you guys. So thank you for asking me to do that.
Yeah, we really appreciate it. I always give a little quick market update. What's going on with the real estate market? It's still hot, hot, hot. Inventory is still low, low, low. We just don't have enough homes to sell. So when they do go on the market, the prices are crazy. But on a good note, even though interest rates creeped up a little bit, they're still good. They're still under 4%. We tell people, don't look at the price, look at your mortgage payment, unless you're paying cash, but look at the mortgage payment, talk to one of our mortgage advisors, see what you're comfortable paying, and then we'll tell you what kind of house you can get and where. And then Paula, why don't you tell them a little bit of what's going on in the financial world? Like what kind of interest rate do people pay on their savings now?
Well, as a result of people being able to buy the houses because the mortgage rates were low, it did affect the stock market in a big way. Now with the rates starting to go up, there's a lot of volatility and there's a lot of stuff going on in the world right now that is affecting the stock market. So right now the stock market is a little bit volatile. The best thing you can do is have a plan and stick to it. But if you're not comfortable when you get your statement or you look at your accounts online, talk to the person that you work with and they can help you adjust it.
Thank you, Paula.
You're welcome.
So I do have a gift card. We have a little contest every month. And so if everybody looks down at the chat box, what I always do is ask a question of what happened in the meeting today. So I'm going to say, and I have a $25 gift card. You can use it at Albertsons, Bonds, the Pavilions. Gosh, a lot of stores that aren't in California. I'm sure everybody uses Albertsons or Bonds. And the first person to type in the chat box, and Chris said what this meant, what does the SALT tax stand for? Something and something. What is that? So type it in. Natalie, you got it. State and local taxes. So I
don't actually want the thing though. So like,
okay.
I just couldn't help myself to
second
participate.
person?
Yeah, do a second.
Margie's there.
Let me look at that chat box.
Margie second.
Okay, Margie, then by default of Natalie not wanting it, although you deserve it, we appreciate you talking. Margie, send me your, if you can put your address or you can text it to me, I will get this off to you. And actually just text it to me. My number is 714-717-1728. Text me your address and Margie, I will get this over to you. If you're local, we'll drop it in your mailbox. If not, we'll mail it to you. Okay. Congratulations. And thank you, everybody. So next month, it will be Thursday, February 17th. And Christy was supposed to be here tonight, but looks like she didn't make it. But she's going to, she's the vice president of Orange Coast Title. So she's going to talk to us about SB 9 and 10, and that's where you can build in the state of California. You can put another building on your property for extra income. And Natalie, you will be here again to tell us any updates on Sunset and Huntington. And does anybody else have any questions for anybody before we say goodnight? Okay, well, thank you guys for being here. Go get your dinner. And we do allow cocktails on this call. It is happy hour. So, and you don't have to, but we're going to continue Zoom through June. And then if it's okay to get back to Kathy Mays, we might do that. But thank you. Good night. Have a great
Bye, everybody.
Bye.
Bye-bye.